So in this video, I will show you how to neutralize a trade. Neutralize means how to de-risk a trade. So whenever you buy a stock, let's say you buy a stock here. Okay, I have discussed this stock purchase in an earlier video. You can check that. So let's say you buy a stock. The moment when you buy a stock, you are taking maximum risk. That's when the risk is maximum because your stop loss is 8%. Okay. As the stock starts to go in your favor, what you could do is you could choose to reduce or completely eliminate the risk in that position. Now, how to do that? Let me explain. So let's say you have a nice base here. I will not discuss why I bought the stock. The yellow line is the buy point and the red line is the stop loss. So let's say you buy a stock, breaks out here, goes up. Okay. Now, what I did is as it went up, as it opened here with a gap up, okay, I knew that it is most likely to be a very positive day for this particular stock. So what I did is the moment it opened here, I placed a target level at 16%. So somewhere here. Yeah, somewhere here, I placed a target. And I decided that I will sell 25% of my shares. Let me draw a line here. Okay. So let's say I buy 100 shares here. The stock opens here. It's most likely to be a positive day. So what I did is I decided that if the stock really starts to go up, I want to sell 25% of my shares when it reaches this 16% level. And it actually happened. Okay. So I ended up selling 25 shares. So let's say I bought 100 shares. Out of 100, I sell 25 shares here. Okay. So which means I have booked 25% of 16% gain. What is 25% of 16%? That's 4%. So I have booked a 4% profit on this position size, whatever be the position size. That is not important. I have booked 4% profit here by selling 25% of my shares. Now, I still have 75% of my shares outstanding, correct? So these 75% shares outstanding, they are still at risk because after this day, the stock could collapse, right? So my goal is to completely eliminate the risk in this stock. How do I do that? The best way to do that is the profit that I have made here should be equal to the loss that I would incur on the remaining 75 shares if the price goes down. Okay. So, how do you place a stop loss? How do you move the stop loss such that the loss that you will incur on the 75 shares will be equal to the profit that you made on the 25 shares? That's the formula. Okay. If you can move a stop loss at that, if you can move your stop loss at that precise level, then you have virtually eliminated the risk in this trade. You don't have any risk in this trade, so to speak. Now, the risk is not zero because the stock could gap down. Okay. It could form lower circuits, but the probability of that happening is very less. So, when you move the stop loss to a certain level, you have almost reduced the risk down to zero. That is one way of eliminating risk from the stock. So what's the formula? The formula is this: 25% of 16%. That's the profit that you make on those 25% of your position. This should be equal to 75% multiplied by new stop loss. So this is your loss, like projected loss if the stock comes down. And this is your profit. So if your profit is equal to your loss, that means even if the stock crashes, you don't lose any money, correct? Now, this is one way. So this value comes roughly 1/3 of 16%, which is 5.33%. So instead of 8%, I will move this stop loss to the 5.33% level. And at that stop loss, I will adjust the quantity because now the selling quantity is small. It is only 75% of the original shares bought, correct? So I will have to adjust the stop loss level and the stop loss quantity. Okay. Another way to completely eliminate risk in the portfolio is to just move the stop loss to the yellow line. Now, in that case, what is happening is you are guaranteeing yourself a 4% gain. Okay. So basically, you are keeping this zero. Okay. So your loss would be zero on 75% of the shares. And on the remaining 25, you made 16%. So that's a 4% gain. So you are locking in 4% gain on whatever position size you have taken. And the remaining 75 shares you completely neutralize. But what's the problem with that approach? What happens if you move your stop loss to the yellow line? The problem with that approach is you are not giving enough room for the stock to fluctuate. See, the stock might want to come down, test the window, test the yellow line, dance around the yellow line, and then double from there. Okay, if the stock wants to do that, you have to allow the stock to do that. Okay, because that it's the nature of the market. It will fluctuate, it will be volatile. So if you don't give room to the stock to fluctuate, there is a good chance that you will be shaken out of the trade. Okay. So please remember, I can easily move my stop loss from 8% to my break even point. But I personally don't want to do that. I want to finance this loss with the profit that I make on this 25% of my position size. Okay. So profit neutralizes the loss. So now effectively my risk in this position is zero. So what I have done is in this stock, currently see this is here, and 75% of my shares are still outstanding. I still own them in my portfolio, which means what? My downside is 0% and my upside theoretically is infinite. Okay, the stock could go anywhere. It could double, triple, even go up 10 times in the next 2-3 years. I don't know. I don't know what is going to happen next. Okay, this is a food delivery company, is a technology company basically. Okay, very popular brand in India. Now you never know what will happen to the stock price. You must have seen stocks which have gone up 10 times in 2-3 years. What if that happens to this stock? Okay, so my upside could be anything. I don't know what my upside is going to be. All I know is my downside is 0%. Okay, I don't want to lose money. And moreover, you see the rising window here. So if I keep my mental stop loss here at the low of the rising window, let me change the color. So if I keep my mental stop loss here at the low of the rising window, see the rising window has the upper line and the lower line. So the lower line of the rising window becomes very strong support. So if I keep my mental stop loss here, and if I take a decision that unless the stock closes below this level, which is like 238, unless the stock closes below 238, I will never sell the stock. If I take that decision now, okay, there could be a chance that the stock might never see the 238 level in its entire lifetime. So this stock could really become an asset for me if it continues to remain above that 238 level. I could hold on to this stock for my entire life as long as it keeps doing well, as long as it keeps above the 238 line, comfortably above the 238 level. Okay. So a stock which I bought as a swing trader could actually become a position or an investment in my portfolio if I manage it properly. I could simply take this stock out of my watch list because the risk is zero. I could simply take this stock and put it in my investment portfolio, not my trading portfolio. Okay. And I can just hold on to it forever. As long as the stock continues to go up, no problem. Okay. So that could be an approach. So you start as a swing trader, and if the stock goes in your favor, you could convert this into uh, a position based investment. You can do that because a stock is an asset. See, when you buy futures and options, you are not buying an asset, you are getting into a contract. And every contract has got an expiry date. Okay. In stocks, that is not the case. You could become a shareholder of the company. When you buy a stock, you become a shareholder of the company, right? And you could choose to keep the stock forever. You could even pass on this stock to your future generation. Okay. So this is really an asset. This is a way that you can build a risk-free asset. But for that, you need to manage the situation properly, you need to set your mental stop loss. You need to set up your hard stop loss. You need to do some formula based calculations to de-risk or neutralize the trade. Only when you have done all of these technical things can you convert this into a asset. Okay, so there is a lot of thinking, a lot of skill that is required to convert this swing trading position into an asset. Okay, now tomorrow, maybe after 1 or 2 months, I might want to remove this from my investment portfolio because it gives me so much gain that I don't want to ride the stock any further. I just want to take that gain and use that gain to finance multiple trading positions in the future. Can I do that? Of course, I can do that. So I have that flexibility in the market to do whatever I want as long as the stock goes in my favor. Now, the flip side, if it doesn't go in my favor, if it starts to fall, what am I supposed to do? There are many things I can do. I can move the stop loss up. I could cut my position size, right? So there are ways to limit risk when the stock doesn't go in my favor. And there are ways to ride a stock or convert this trading position into a positional investment if everything goes well. Okay, currently everything seems to be going well in the stock, so I'm not disturbing or touching this position. Okay, if it doesn't go in my favor, then I will do some damage control. I will try to reduce the risk further in the stock. See, my gains are not protected in this stock. My capital is protected. My gain is not yet protected in the stock. Okay, I can do that. I have the flexibility to play around with my stop loss. So this is the formula. Don't forget this. The profit that you book on your 25% of your position should be equal to the loss that you are planning to book. Okay, if the stock doesn't go in your favor. So these are two different position sizes, 25% and 75%. The second position is 3 times bigger than the first position. So you have to keep the stop loss at an optimum level, mathematically calculated level, where if it hits your stop loss, your overall, you have no loss, no profit in the stock. But you have given yourself that opportunity to take that free bet. What do I mean by free bet? Free bet means, let's say you are playing a betting game and you have to bet $10 to make $100. Okay, so you bet $10, you lose. Again, you bet $10, you lose. Again, you bet $10, you lose. So now your loss is $30. Now in the fourth bet, okay, you win. Now tell me what is your gain. Okay, so you bet 4 times, so your loss is $40, but in return you made $100. So your 100 minus 40, $60 is what you made. Now why that $60 is important is because that $60 allows you to take 6 free bets, because every bet will cost you $10. So you just financed the next 6 bets that you are going to take. Same is the case with trading. Okay, this is like a free bet. If it falls, I don't lose any money. If it goes up, I'm continue to make money. That's the situation I want to be in. So in this video, I have tried to explain to you how to neutralize a trade, how to de-risk a trade, or how to eliminate the risk from a particular position. So I hope you understood the formula. I hope you understood my thinking process here. If you have any questions, please let me know in the comment section. And I request you to please like, comment, and share this video so that this video reaches like-minded people like you, people who really want to become professional traders, but they don't get proper guidance. Okay, so please help me grow this YouTube channel so that a lot of people will benefit from it. Okay, thank you so much.